Hello, everyone, and welcome to our Tax and ESG webinar. This is the fourth and final webinar in our 2022 Quarterly Perspectives on Tax Law series. While I introduce myself, please see the information slide that is coming up on your screen. My name is Christopher Steeves, and I'm a partner in Fasken's Toronto office and also the leader of the firm's tax group. Today's topic is tax and ESG. As everyone knows, ESG is a growing area of importance and concern around the world that is pervading every aspect of business. While tax is increasingly relevant to environmental policy and sustainability, my comments today will focus on tax transparency as part of the social column of ESG and accountability for responsible tax policy as part of the governance column. Now, onto our presentation. So here on this slide, you'll see our brief agenda. We're going to talk about what is ESG. Then we're going to talk about putting the T in ESG for tax. On the third item on our agenda, we're going to talk about tax and transparency. And then finally, we're going to talk about important considerations. Here you can see what the ESG columns are. We have environmental, social, and governance are all non-financial performance indicators that stakeholders use to assess companies. ESG generally supports the proposition that long-term value is created by companies that embed ESG concepts into their strategies. Here you can see the types of considerations that fall into these three columns of ESG. The last item in each box highlights possible tax considerations. As I mentioned, today I'm going to focus on the social and governance columns dealing with transparency and accountability for responsible tax policy. In the last decade, perhaps starting around the time of the global financial crisis in 2008, civil society has become more attuned to what businesses are doing and how their activities may impact everyday life. As part of this awareness, business has begun to recognize that their actions or inactions can significantly impact on their value and how the business is viewed by all of their stakeholders, not just their shareholders. As part of this development, ESG was popularized and various ESG ratings have begun to appear. On this slide, you'll see some of the rating agencies that have popped up. ESG ratings provide a basis for businesses to demonstrate to their stakeholders how they make positive impact in the geographies where they operate and can provide valuable support for their brand, as well as distinguish them from their competitors. No single or accepted methodology for calculating ESG ratings is, pervasive. Various rating agencies may provide different assessments of the same company, and many of these commercial organizations have developed their ratings and rankings, evaluating ESG factors based on the various standards and providing quantifiable metrics. MSCI, S&P, and Sustainalytics are just a few of the industry leaders that many ESG rating, these are the main ESG providers. So institutional investors are also integrating ESG factors into investment decisions. Investment managers and portfolio companies are adopting ESG practices as part of risk management and as a means of differentiating their business. The concept of ESG now encompasses companies' disclosure practices, companies' commitments to promote sustainability and improve environmental, social, and government profiles. Of course, governments are also adopting an ESG lens to how they apply, change, and create new legislation and policies. Tax is playing a critical role in ESG standards and metrics. So let's switch to tax. What is the T in ESG? On this slide, going back to those three columns, I've flushed out some of the areas where we're seeing tax considerations. In the environment area, we're talking about carbon taxes, In Canada, we've seen consultation regarding investment tax credits and clean technologies. There's been consultations regarding clean hydrogen as well. On the social side, there's a growing public awareness of aggressive tax planning structures, and also the pressure on businesses to pay taxes in order to finance the cost of roads and schools, hospitals, social programs, and other critical infrastructure. And finally, on the governance side, there's a growing awareness of accountability for responsible tax policy and appropriate risk management. So when we look at where ESG and tax come together, in recent years, the World Economic Forum has outlined that total tax paid is a reportable metric to reflect a corporation's contribution to public finances through direct and indirect tax. The Global Reporting Initiative has also identified tax as a significant component of economic value generated for a country in its Standard 201-1. Recently, we've seen a group of Danish pension funds who've developed and signed a tax code of conduct to help support goals of responsible tax behavior in their investments and through their investment partners. And Norges Bank recently divested from companies that it felt had a weak or no reporting related to tax and tax transparency. So why is tax important? Tax-paying entities are becoming increasingly focused on having the appropriate tax risk management and governance framework in place to ensure that material tax risks are given due consideration. Institutional investors are asserting their influence in portfolio companies to adopt tax risk management and governance frameworks that are similar to their own. And investors are looking at how businesses manage their tax affairs as an early indicator of how they might be managing other aspects of ESG. In other words, if they're neglecting their tax governance, perhaps there's other aspects of governance that are also falling behind. And responsible tax policies and transparency help build trust that with all the company's stakeholders, including the public, their clients or customers, and employees. So continuing with this idea of why is tax important, aggressive tax planning we've seen can expose a company to legal, financial, and reputational risks. On the right-hand side of this slide, you'll see a number of high-profile examples of businesses that were dragged through unfavorable headlines related to their tax practices or tax planning. For companies in consumer-facing sectors, negative media coverage regarding tax can also result in boycotts and consumer backlash. It also undermines efforts by the company to positively raise their corporate responsibility profile and affects their brand value. And on this slide, you see from Interbrand Best Global Brands of 2013, the impact that tax has had on brand value. Now, I think it's fair to say that some of this negative publicity was not always fair or warranted. And as I'm going to discuss a little bit later, taxes are complicated and it can be difficult for consumers or the general public, or dare I say politicians, to understand why a successful business may pay little or no corporate income taxes. And also, I think it's also fair to say that the standard of what represented responsible tax planning has evolved very quickly, and these changes to these standards appear to be accelerating, perhaps in part due to public awareness arising from leaks like the Panama Papers. And in part, it's fair to say it could be a reaction to the general lowering of corporate tax rates globally, which creates this view that perhaps corporations are greedy, that they, as their corporate tax rates are falling, they should be, taking less part in aggressive tax planning. But there's tension. Tax is still a major financial factor for businesses, and it's one that an investment committee or shareholders are considering when they're assessing their return on an investment. So let's switch gears and talk about tax and transparency. Tax disclosure by companies in public to the public is largely voluntary in Canada. However, the obligation to report to tax authorities has been growing, and I've got some examples on this slide. A key component of the transparency pillar in the OECD BEPS project is the obligation for all large multinationals who hit a certain revenue target to file country-by-country reports. The OECD has provided a template for these M&E groups to report annually for each jurisdiction which they do business, the amount of revenue, profit, profit before income tax paid and accrued, as well as a number of employees, their stated capital and retained earnings and tangible assets. Now, I think it's fair to say that extractive industries, oil and gas, mining, these industries have been a bit ahead of the curve. They've been dealing with this since the early 2000s. And in Canada, at least, there are certain required disclosures under the Extractive Sector Transparency Measures Act, reporting what their, which creates reporting obligations. So here's an example. I thought this is a really interesting slide from First Quantum, which is a Canadian multinational mining company. And for the last several years, they've been producing a tax transparency report. And you can see on this report for 2021 that as a whole, they paid $1.5 billion to various governments around the world where they have operations. That's a very powerful statement when you look at it in terms of the dollars that are going into the economies of the geographies where they operate. Here's another one for Vale. Vale, again, a global mining company, and you can see on this slide for 2021, they paid $9.3 billion worth of taxes, largely to Brazil, I think, which is where much of their operations are located. And obviously, in terms of the positive message that a public company wants to get out there, they're showing how they make a positive contribution to the communities where they operate by paying huge taxes, not just income taxes, but all kinds of taxes that they might for payroll or for royalties and other things like that. It's important to note that tax transparency is not new, and you can see on this timeline on the right-hand side that starting with those extractive industries in 2003, there have been a number of events that have occurred where businesses are coming forward and disclosing publicly what their taxes are. And there's pressure on businesses from governments, investors, regulators, the media, civil society, and the public to disclose more about the taxes that they pay. This is particularly true for multinationals. I'm going to focus on what's happening with some of Canada's major allies and trading partners. And these next couple of slides were shown in that timeline. In Australia, starting in 2015, the Australian government published a set of tax transparency rules regarding public disclosure of certain information relating to the tax affairs of large corporate entities in Australia. These rules are designed to discourage large corporate tax entities from engaging in aggressive tax avoidance practices. The rules require the Australian Tax Office, or the ATO, to publish the company's name, their total income, their taxable income, and the income tax payable for corporate tax entities for an income year whose total income for that year exceeds 100 million Australian dollars. And corporate tax entities for these purposes includes companies, certain trusts, and limited partnerships. Each year, the ATO publishes 2 reports on corporate tax transparency. First, they have something called the Report of Entity Tax Information, which is essentially a spreadsheet which contains an alphabetical listing of tax information of Australian public and foreign-owned corporate entities and Australian-owned resident private companies that meet that income threshold, as well as entities that have petroleum resource rent tax payable. The second report that they produce is called the Corporate Tax Transparency Report. And this is the ATO's contextual analysis of that above data It also has key insights on the population, trends, losses, nil tax payable, and other relevant informations. And then this is the interesting part. Under Australian, the ATO also is encouraging people to publish their own reports on a voluntary basis. And they've created something called the Voluntary Tax Transparency Code to allow companies to explain their tax positions in more detail. And this code is said to complement Australia's corporate tax transparency measures. So here's an example of the spreadsheet. Here's an excerpt from the spreadsheet that shows, in the top part here, you see the people paying the petroleum taxes. And on the bottom part, you see those that are paying what their taxable income is, what their income is, the taxes that they're paying. And you can imagine, if you look at this, there's a few places where the taxable income is left blank and the tax payable is also blank, but yet there's substantial total income. And so there's pressure on those companies, I'm sure, to explain why it is that they have such large total income, but no taxable income and aren't paying any taxes. And here, as part of the transparency report, they break it down by industry. So you can see on the left, banking, finance, and investment, the level of tax over the various years that are being paid by the industry, and they have other insurance, manufacturing, wholesale, mining as being, so you can see the breakdown of what taxes these large corporations are paying over a 5-year period. So let's leave Australia and travel to the UK. A year later, so that Australian Tax Transparency Initiative was in 2015. In 2016, the UK, the HMRC announced requirements for businesses to publish a tax strategy if their previous financial year had either turnover or profit of £200 million or had a balance sheet of over £2 billion. And these rules apply to businesses that are a UK group, subgroup, company, or partnership. UK companies or groups that are part of a multinational enterprise group that meets the OECD's country-by-country reporting framework threshold of global turnover of over 750 million euros also are required to publish their strategy. So what is this tax strategy that they're required to publish? The requirement in the UK is that the strategy has to be approved by the business's board of directors. It has to be in line with the business's overall strategy and operation of their business. And it has to include details of the provision of this legislation that applies. It has to look at the financial year that the strategy relates to. It has to describe how the business manages its UK tax risks. It has to look at the business's attitude to tax planning. I'd love to read some of those paragraphs. It also looks at the level of risk that the business is prepared to accept for its UK taxation and how the business works with HMRC and any other relevant information related to tax. Now, the tax strategy in this case differs from the Australian model because they don't need to include the amount of taxes and duties paid as part of their tax strategy or information that might be, quote, commercially sensitive. Now, there are penalties if you don't comply with publishing your tax strategy, or if you publish an incomplete strategy, or if you do not make sure that the published strategy remains available for free for an appropriate period of time. The business can be charged, if you don't meet those requirements, with a £7,500 penalty for not publishing a strategy, a second £7,500 penalty if the strategy has not been published within 6 months after the deadline, and another £7,500 penalty for each of the following months until the strategy is finally published. So what's happening in Canada? Well, most recently, Canada is introducing new mandatory disclosure rules and expanding on some others. So this fall, we saw some additional discussion to announcements that were made in the 2021 budget. And in that 2021 budget, there was this comment from the Department of Finance. The lack of timely, comprehensive, and relevant information on aggressive tax planning strategies is one of the main challenges faced by tax authorities worldwide. Early access to such information provides the opportunity to respond quickly to tax risks through informed risk assessments, audits, and changes to legislation. It's pretty incredible stuff. The Income Tax Act contains rules that require certain transactions to be reported to the Canada Revenue Agency. However, the CRA's experience with these rules since their introduction indicates that they are not sufficiently robust to address these concerns. So as part of the 2021 budget, the government proposed expanding the existing reportable transaction rules in section 237.3 of the ITA and introduced a new category of notifiable transactions and also required reporting for certain uncertain tax treatments. So let's talk about reportable transactions. A reportable transaction under these new rules is an avoidance transaction in a series with an avoidance transaction, and it was entered into for the benefit of a person, and any of the following hallmarks are applicable. And this is a change, that this type of reportable transaction under the mandatory disclosure rules was around before, but under the previous rules, you had to satisfy at least two of these hallmarks. And now they've said if any of these hallmarks are present, you fall under the mandatory disclosure rules. So the first requirement, the first hallmark rather, is if the advisor or promoter fee is based on the amount of the tax benefit or is contingent on obtaining the tax benefit, or is based on the number of persons that participate or have been provided access to the advice. The second hallmark is where the advisor or promoter obtains confidential protection, which is generally limited to the tax results from the transaction or series in respect to the avoidance transaction or series. And then the third hallmark is if the person, an advisor, a promoter, or any combination of those, including non-arm's length persons, have contractual protection in respect of the avoidance transaction or series. So if you fall within those rules, if one of those hallmarks is present, then you are into the mandatory disclosure requirements. And these requirements operate on a transaction by transaction basis. And the taxpayer has to report within 45 days of certain specified events. And similarly, advisors also have to separately report within 45 days of certain specified events, where either the fee hallmark or the contractual protection hallmark is met for that particular advisor. So if you don't file a report, the penalties can be severe. So until reporting, and the payment of the penalty as applicable, the general anti-avoidance rule in the Act is read without one of the major outs, and that is, in order for the GAR to apply, there generally must be a misuse or abuse. So if you miss your reporting, that exception to the GAR does not apply. In addition, the normal reassessment period for that year is extended. And then there are financial penalties that are applied per week up to a maximum for late filings. An advisor or promoter penalty for failure to report is equal to the fees that they charge for the services they provided, plus $10,000, plus $1,000 per day, up to a cap of $100,000. So they're serious. These are very serious penalties. And there's joint and several liability for the penalties, with a limited due diligence exception for penalties. And when I say joint and several, that means the advisor, the taxpayer, could be multiple advisors involved in a particular transaction, could all be jointly and severally liable for those penalties. Now, the effective date for these new rules dealing with reportable transactions is going to be when the legislation implementing these rules receives royal assent. Originally, these rules were to come into force on January 1st of 2023, but in the 2022 fall economic statement, the government postponed their effective date until they receive royal assent. And I believe that there are some some continuing concerns in the tax community about how these rules will apply. They're extremely broad, and the expectation is that there'll be further changes, and that's why they've agreed to defer the January 1 effective date until they can kind of smooth out some of the technical issues that have been raised by the tax community. So moving on to notifiable transactions. A notifiable transaction is a transaction that is the same as or substantially similar to a transaction or series as has been designated by the minister. So there will be regulations that will have a description of what these notifiable transactions are. Currently, there are none designated. The draft legislation has 6 samples, but it's interesting to note that the province of Quebec introduced notifiable transaction rules several years ago, and their rules, their regulations already have a prescribed list of transactions which are notifiable if you're operating in the province of Quebec. So taxpayers who are expected to realize a tax benefit are, in respect of these notifiable transactions, must report within 45 days of certain specified events. And similarly, advisors must report within 45 days of specified events as well. And there's no requirement under these rules that the advisor even receives a fee. So if there is a failure to report these notifiable transactions, there's a penalty, financial penalties, either $500 or $2,000 per week, up to a maximum for late filings. And again, the normal reassessment period is extended. Advisors or promoters on an individual basis are subject for failure to report. And again, if they did charge fees, the penalty will be equal to those fees charged, plus $10,000, plus $1,000 per day, up to a cap of $100,000. And again, with these rules, there's joint and several liability for penalties, with a limited due diligence exception with respect to the penalties. And again, like the mandatory disclosure rules I mentioned at the outset, the effective date was extended for the fall economic statement, and these rules will come into force when the legislation finally receives royal assent. And then the third category of new rules are the reportable uncertain tax treatments that companies may have. The US has had some rules like this for many years, but Canada is jumping on the bandwagon, and the tax treatment of a corporation where there is uncertainty reflected in their relevant financial statements will be required to be reported. The corporation, in order to be caught by these rules, has to have, quote, relevant financial statements or within their consolidated group. The carrying value of the corporation's assets has to be greater than or equal to 50 million, which is a pretty low threshold. And the corporation is required to file an income tax return under the Income Tax Act rules. So the deadline for this is when they file their corporate tax return for the year, and advisors in this case do not have any filing requirements. Penalties, again, they're substantial. Importantly, the normal reassessment period is going to be extended until the report is made, and you can be looking at $2,000 a week up to a maximum of $100,000 if you do not disclose your uncertain tax positions. There's again limited due diligence exceptions for these penalties, and again the effective date will begin when these provisions receive royal assent. And there are more changes coming. I think it's important to appreciate when you see what these rules are like, what we have seen in Australia and within the United Kingdom. Canadian companies should be prepared to be more transparent regarding their taxes and other payments to and from governments. And I think we've already seen the first step. The Canadian government took that first step on full public transparency under the provisions of the Income Tax Act when it introduced the Canada Emergency Wage Subsidy. In contrast to the general taxpayer privacy and confidential requirements in the Income Tax Act, the wage subsidy legislation in the Income Tax Act allows the CRA to communicate or otherwise make available to the public in any manner that the CRA considers appropriate the name of any person or partnership that made an application for the wage subsidy. And they followed up on that. They used that power. In December 2020, the CRA published a searchable database on its website with the names of companies that received the wage subsidy or had applied for it, but it didn't detail how much each company or group had received. And this database was updated after December 2020 and is still available, searchable on the StatsCan website, which is, in my view, is quite an extraordinary step where what used to be considered private taxpayer information was put together in a searchable database. So any member of the public could search and see if their favorite coffee provider was applying for subsidy, or if their grocery store had applied for subsidy. And I think that is sort of like could be the floodgates for governments requiring disclosure of tax information about certain taxpayers. So being prepared and proactive about tax strategy and transparency ties into a company's larger ESG goals. It's important for risk management. And I think what we're seeing is, there's not always great understanding among stakeholders because tax is complicated and sometimes misunderstood and overwhelming. And when tax issues arise, having tax transparency and a carefully thought out narrative that explains the concepts behind a business's tax strategy minimizes the risks, including reputational, legal, and financial risks. As I mentioned, capital markets, investors are increasingly interested in understanding the tax strategy of the businesses that they are investing. The CDPQ has published in 2021 its Sustainable Investing Report. And here, just a couple of excerpts from that report, which is quite extraordinary, that their conviction is companies should pay their fair share of income tax to maintain a fiscal balance that will allow governments to fund the programs required for collective well-being. It's hard for anyone to really argue with that. Of course, the challenge is always determining what is a company's fair share. So many changes are coming. We're seeing in the mergers and acquisitions context, increasingly tax transparency and information regarding the tax strategy of a target provides guidance to potential buyers about the target and how it looks at tax risk and perhaps ESG more broadly. A target's history of aggressive tax planning may cause potential buyers to walk away from the transaction as businesses become more ESG conscious. Is this a reputation risk post-closing that a company does not want to buy? So let's segue into important considerations. The tax transparency needs will vary for each business, but it's crucial for companies to start thinking now about tax transparency and responsible tax planning. Notwithstanding that the Australian Tax Transparency Code and Register is voluntary, the Australian government expects that all responsible large and medium businesses operating in Australia will adopt it. According to a recent evaluation by the Australian Corporate Tax Association, the current signatories registered with the board represent more than 60% of taxable income and tax payable by corporate taxpayers who are potentially subject to the TTC. So that's 60%. It's pretty incredible. And here's an example of what it looks like. So this is from an Australian company that shows who's voluntarily disclosed what its taxes are. It shows that they paid no income tax in 2019 or in 2020, but it shows that they paid GST, they paid substantial payroll taxes, they paid employee payroll taxes and other withholding taxes. And it shows that their overall tax contribution in Australia nearly doubled from 2019 to 2020. And that's an important dialogue. I think a lot of people, they focus on corporate income tax number and they don't focus on the other taxes that a company may pay. And so again, that determining what that fair share of taxes is complicated. But having something that's out there that's easily accessible to your stakeholders can demonstrate that you are making contributions to your community. And that can be a very valuable thing. So on this slide, we talk about how businesses seeking to build a narrative, connecting tax practices to values and strategies while also demonstrating a commitment to ESG should consider the following. Boards, management teams, tax directors need to understand the company's tax position, not just from the shareholders' point of view, that's the traditional view, but also from the perspective of investors with a focus on ESG, employees, civil society, and tax authorities as well, of course. Tax departments need to engage across the entire business to align their tax strategy with a broader corporate strategy. And tax disclosures are often read by people who are unfamiliar with tax. So clearly communicating a tax narrative can prevent those misunderstandings. As I said earlier, focusing on corporate taxes can minimize a company's meaningful tax contribution in other ways, including payroll taxes, indirect taxes, and withholding taxes. Businesses should think about how they compare to their peers and factor that into their tax transparency reporting. So how can Fasken help? At Fasken, we're really on the front line of M&A transactions, capital markets. We deal in borrowing and lending and tax planning as well. We're witnessing the evolution of what is acceptable tax planning versus what is not. We regularly have technical discussions with our colleagues around the world about what they are seeing and what tax authorities are challenging. With legislation that I talked about earlier, with these new notifiable transaction rules, there will be regulations that will spell out exactly the types of transactions that raise concerns with tax authorities and are likely going to be subject to audit. In the context of M&A deal or a capital raise, we can review and comment on the tax approach taken by a target or an issuer and provide feedback as to whether or not that, on what side of the aggressive scale that seems to be. And we can also help prepare a potential target company or a business in general to address tax transparency and develop its tax strategy. With this context, skipped ahead too far there. With this context, we're ready to assist businesses as they develop their plan to weave tax considerations into their broader ESG strategy. So with that, I'm going to pause and open it up for any questions that people might have. Okay. Well, thank you very much for your time. I particularly appreciate you choosing to participate in our webinar today, notwithstanding the fact that Canada is playing in its first World Cup soccer game since 1986. And maybe that's why there's no questions, that people are eager to watch the second half. So again, thank you very much. A reminder to please fill out the survey if you haven't done so already. If you missed any of our past webinars in the quarterly perspectives on tax law series, please visit the past events section of the Fasken Institute, which can be found at fasken.com. Oh, wait 1 second, a late question. Okay, we have a question here that says, of particular interest to me is how the responsible portion of responsible taxation is evolving in the context of awareness of non-financial ESG factors. Well, I touched on that in our presentation. I don't think there's a lot of magic to those this evolving aspect. When I first started practice many years ago now, offshore tax planning was something that was quite routine, and I think. As things like the Panama Papers have made that type of planning seen as being greedy and inappropriate. And I think that combined with dropping corporate tax rates, the tolerance for offshore tax planning in tax havens is really seen as highly aggressive and inappropriate. And as I said, I think that these, what's seen as responsible today is very different than what it was 20 or 30 years ago. And I think, we have to keep an eye on all types of different tax planning and where there is a deferral of tax, obviously that is seen as less aggressive. Where there's an absolute avoidance of tax, that is seen as more aggressive. And there's a whole shade in between. And so trying to figure out which is responsible and which is not responsible really depends on the context of the business, the context of the industry, the context of competitors in that industry. And it takes a lot of sort of knowledge of those three things in order to determine whether or not a particular tax plan might be considered responsible or not. So with that, again, I thank you all for joining, and have a great day. Bye for now.